Okay, it's 11:30. We are going to go ahead and get started. Welcome, everyone. My name is Duren. I'm a director here at Lutz in our Client Advisory Services group. I specifically work with independent medical groups and dental groups. So 80% of my time is in this healthcare world, and I'm really excited to introduce my co-presenter.
I'm Tom Hodgson. I'm a financial advisor on our Lutz Financial Division, and we work with a lot of high net worth individuals, including doctors, business owners, and the sort. And obviously, this presentation will be focusing a lot on the healthcare transition planning, retiring physicians, and what we think value adds are to get ready for that stage.
Yes. So brief overview of Lutz. Many of you on this call are already Lutz clients. Some of you are not. So quick overview of the entire Lutz network. We're really a one-stop shop for businesses. The core of our business started with accounting. We call it the mothership of our services, with your typical audit and tax and other accounting services, and then a variety of consulting within business valuation, healthcare consulting, things of that nature. Lutz Financial, which Tom works in that division, financial planning, investment advisory, retirement plan services, things of that nature. We have an M&A division. We also have a talent division within that. Our newest offering is outsourced HR. And then we also have a tech division, outsourced IT, help desk, data analytics, all things technology. So if you need help with anything else, aside from what we're talking about today, please reach out. We have a wide variety of offerings. So last year we did a presentation that's really part one of what we're talking about today. We focused on medical practice transitions and really getting the biggest value out of the practice and going through different types of transactions, whether it's to another physician or due to a retiring physician, a third party sale to a competitor, things of that nature, pros and cons of all of that, and just all of the varying elements of transitioning the practice. That's really that part one of this three-legged stool here, optimizing the value. What's boxed off here is really what we're focusing on in this presentation, really the personal financial readiness of the individual physician and life after business planning for the individual physician. We did get feedback and questions on wanting a more deep dive into what practices and physicians need to consider when the transition is specific to a retiring physician. So I'm explaining all that. There is a part one to this. It's not necessarily required for you to listen to before today, but we will include the materials on that. I think it's important to watch that if you haven't already, after our presentation at some point, just to close the loop on everything we're talking about. We may reference a few of those pieces or parts. So the importance of what we're talking about today, obviously you're on this call for a reason. I'm sure you all know why this is important, but just to throw some stats up here to really hit home why we need to be talking about this. There's this term that's coined, the silver tsunami is approaching or is arguably here. A lot of our clients that we work with have expressed major concern about their own transition plans or transitions within their practices. And we know that this is a huge topic in the industry right now. In general, our population is aging. With that, our physician population is aging as well. The stats up here, 2 out of 5 active physicians will be at retirement age in the next decade. So I think the plans in place, you really got to start thinking about this now, just given these stats. We want to ensure ultimately the survival of these independent medical groups. And in order to do this, the physicians need to be aware of what they need to do to help foster that transition planning. And so that's really the crux of what we're going to get into today, is the physician side of it. So I love this slide because a lot of the people on this call are either business owners or practice administrators. And I think it's interesting how many hats you all wear on a daily basis. So timekeeper, clinical operations, accounting, HR, therapist, whatever you want to call it, you're handling it all. And so, or facilitating it all. usually, and so it really starts with ensuring we're supporting you and giving you the good tools and talking points to bring this back. Or perhaps this is something very applicable because you're a physician yourself trying to plan for your own retirement and you own a practice. And so really, this hits home. So we're gonna go through a variety of things. What is transition planning, practice preparation, and physician readiness, and financial planning? So we'll really get into the crux of financial planning specifically. So this whole idea of transition planning, such a buzzword, and it's really all encompassing of a lot of different things. You've got estate planning, you've got succession planning, which at the end of the day, you know, proper retirement planning needs to be smooth. And in order for your patients to have continuity of care, we really need to ensure that we're identifying any gaps that this could potentially cause. I think that's a big piece of why this is so pertinent to medical practices. Is at the end of the day, again, we want to ensure the perpetuity of the practices that we're talking about. And so proper planning on the physician side is important to ensure that continuity of care. From a financial stability perspective, helping manage the financial aspects of the practice, but also all the things that it comes into with recruiting and stuff like that, evaluating the business itself. Contingency planning, of course, this is a big workforce. The people working at the practice, of course, want to ensure that there's a plan in place and that their jobs are, you know, gonna continue. Just if somebody is going to retire, there's not gonna just be a huge gap or, oh, the business is gonna fail because we didn't plan. So this is a really big, important piece of just even ensuring your workforce is confident in the perpetuity of the practice itself. Developing a good exit strategy. Not only does that mean an exit strategy for the physician themselves with their own financial situation, but also then if it's a high producer that's leaving the practice, how is that revenue or that production going to get supplemented or replaced? Again, with the recruitment strategy, fulfilling those gaps so the continuity of the practice continues with the level of production it's used to. Then, of course, executing the actual sale goes into play here. The wealth management side of it on the back end for the individuals involved in a potential buyout. And then, of course, there's the individual personal physician goals and then the corporation's goals. So we're going to be touching on a lot of this throughout, but there's so many different facets that go into transition planning and business succession planning that it really is important to start this conversation early, not necessarily 30 days before somebody wants to retire. That's too late. I love this slide. We use this in a lot of our presentations. The 5 Ds. So everyone has a plan until they get punched in the mouth, we like to say. So nobody can ever plan for the 5 Ds necessarily, or know when they're going to occur, but it's really good to have a plan. So if and when one of these, death, disability, disagreement, divorce, or distress occurs, there's a plan laid out. The stat on the slide here, approximately 50% of business exits are not voluntary. That's a really telling statistic of, 50% is not voluntary, meaning you really didn't see this coming. So we have seen this a lot in the last couple of years, whether it's a divorce or a disability or an unexpected death. And really navigating these when there wasn't a plan in place becomes challenging, not only from the emotional side of it, but then of course the outcomes are not always what the original business owners had intended. So it's important to have a plan. There's a lot of detail on these next few slides. I'm going to skip through these rather quickly, but I wanted to keep the details on the slides so you have them, because we will be sending the slides out after the presentation. But a lot of times physicians they know they're not going to work forever, but the reason they delay to get this transition started is a lot of times they just don't even know where to start. It's overwhelming. They're focused on practicing their medicine and they just simply don't know where to start. And the process seems rather challenging and they don't have time for it. So having the right advisors in place and having really good proactive conversations can eliminate some of the reasons why this does get delayed. But these are very, very common and very understandable. So I think it's really important to just meet the providers where they're at, acknowledge, hey, we understand why some of this is getting delayed, but it's critically important, as we discussed on the previous slides. Some common readiness issues, of course, maybe if there's multiple shareholders, they may not all be on the same page with the transition plans. Who or what is going to be our succession plan? Do we have a recruitment strategy? Is there another provider that maybe wants to become a shareholder? Are we all on the same page with that? Maybe the owner doesn't necessarily have a goal or an objective. We've seen this time and time again where a provider thinks, oh, I'm going to retire in the next couple of years, and then that timeline just keeps getting extended. So there's really no true set timeline there. The contingency plans and the owner considerations to what is next is also some common readiness issues that we see. And then, of course, from the financial aspect, which Tom's going to get into, the planning was maybe not done proactively on the front end, so it ends up delaying or avoids the subject altogether because maybe the value on the back end wasn't what they expected. So we'll get into that in quite a bit of detail throughout the rest of the presentation. A few of the benefits of doing this, and I kind of already touched on this in some of the previous slides, but obviously all of the reasons listed on here would be benefits of getting this planning started sooner than later. We've boxed off the 4 areas we're really going to touch on today. Last time we were really focused on the clarity, the best in class, the maximizing the value, the shortening the due diligence process, the control, all of those aspects. So click the link to watch the original part 1 of this to get more details on that. But today we're really going to talk through helping achieve both the business and the personal physician goals, control how and when they exit the business, minimize the tax consequences of exiting the business, and then of course securing the future owners, family, employees, all of the parties and stakeholders involved. So now I'm going to dip it over to Tom.
Yeah, so I'll kind of take over a little bit here, go through the financial planning aspect of this. So these are going to be the key components that we talk through today. So retirement cash flow planning, the tax planning. Again, I think tax planning is very incorporated throughout all of this. And that's why, again, we partner so much and we do a lot of crossover. Estate planning, risk management are 2 big ones that I think, again, goes back to the 5 Ds and making sure that you plan ahead. Nobody ever expects to go through these kind of events, but having a plan in place ahead of time can help ensure proper flow of things how you want versus, again, having it be after the fact. And then when you think more about the retirement planning side of it, distribution and balance sheet management, and then lastly, investment planning. So those are going to be kind of the topics that we highlight and talk through. Again, when we've polled a lot of our clients that have gone through the financial planning process, these are some of the key takeaways they come away with. And I think the big ones that we help with as being kind of a partner along the way is the accountability, the objectivity, and then being proactive. Again, a lot of this, and we kind of talked about this, you have a plan in place until something changes. We don't want it to be that something changes and it's too late to then have kind of the guardrails in place. So when we start with the retirement cash flow piece with clients, this is kind of a high level snapshot of what they can go through. So this is an example, and again, you kind of see the names on the bottom. It's a generic Sam and Sally Smith profile. Clients that are getting ready to retire, you can kind of see the purple dot at the top. They retire, they've got a lot of pre-tax assets set aside. They live throughout retirement. They get to the point they start taking required distributions. And this picture looks great. And so again, I think there's a lot of ways that you can solve retirement. And we tell everyone it's kind of like an algebra equation. You can change any of the variables. It may just change something else throughout there. So again, no 2 clients that we work with have the exact same goals. Sometimes people want to retire earlier. Some people want to work forever. Some people want to spend more and travel. Others want to leave a bigger legacy. So again, there's not a right or wrong answer. But what we want to help clients do and think through is how to optimize that. So again, you'll kind of see this as a baseline example. The colors represent different account types. And I'm going to show the next one. again, I think where we can add value is helping think through some of those buckets. So the difference between the previous one and here, again, if somebody did a better job planning ahead of times, having contingency plans in place, maximizing the value of your business, you can kind of see that that dark blue bucket or the taxable account types boosts up a little bit higher than the previous one. You're able to optimize the value of your business and sell it for potentially more, transition it for more. But then the other thing that we want to help clients with is, again, maximize your taxes for the 40 years of retirement, not each calendar year. So you can kind of see that green bucket is the Roth bucket. And I think that's, again, where we can help add value of just looking at things on a year basis. We know that, again, life evolves, things change, but that's why we want to look at this snapshot, and we meet with clients multiple times a year to go through these different pieces and see what's changed. And again, look at the taxes, especially you get later in the calendar year also. Some things that we want to think about when we're going through that financial planning process, again, is kind of a breakdown of what your buckets look like. So again, this is different for everybody. For business owners, you may own the real estate, you may not. That could be an important factor of it. What your expected income is throughout retirement. So again, everyone's different here. Social Security is likely going to be here in some capacity. We don't know for what capacity, but will you still get practice income? Do you have different entities that are paying you income throughout? Do you want to work or consult throughout retirement? That can impact your income. Then again, we talked about if you own the real estate portion of your business, maybe you retain that, but you sell the practice. So there's some income coming in. So everyone's situation is different, but I think this is where you kind of start to think ahead of what these look like. But then that also looks at the next part we showed you on that slide. But should you prepay taxes in retirement? I think where we on the financial planning side differ from a lot of CPAs and the thought process is, how can we minimize taxes, not just in a single year, but for the next 40 years throughout retirement? And if we do nothing, you kind of saw on that first slide, you may end up paying more in taxes later on, where you might have higher required distributions. Those start at age 75 now for people. And again, when we think about some of the new tax laws that have changed, you see that as legislation changes will continue to happen over time. But one of the most recent ones, I guess the One Big Beautiful Bill was the most recent one, but prior to that, the Secure Act 2.0, that changed how people inherit assets as well. So if legacy planning is an important area for people, we want to maximize not only the value during your lifetime, but passing it down to the next generation as well. So you may be prepaying taxes during your life to save on taxes later on. Because in the new rules for inherited assets, if it's a pre-tax IRA or 401k, beneficiaries have 10 years to fully deplete those buckets. So again, that could materially impact, again, kids or beneficiaries on how that looks. And another big one that we see a lot of times with clients is, again, most of our client base started off here and have Nebraska ties, but a lot of times people move during retirement. Maybe you move to a lower state income tax state or no state income tax state, or maybe you move to a higher state income tax state. That all matters as well. And again, if you have plans ahead of time and you know for sure what that looks like, you can get very efficient on how you maximize the dollars that are working for you. So again, I think that's a big thing to kind of think through. And then charitable intentions is obviously something that we help a lot of clients with as well. I mean, we see this here in Omaha. People are very philanthropic and give back. It's not our job to tell you how to give your money if that's a goal of yours, but we do want to help maximize the value for you and make a bigger impact. So again, thinking of some of the tax giving laws and what you can give where, how you can maximize it, how you can minimize the tax impact of that are all considerations when you're kind of thinking through some of these pieces of it. With the One Big Beautiful Bill, so obviously that was passed in July of this year. Overall, that's a positive for most of the clients that we're working with. And the biggest impact, I would say, is something that you won't necessarily see from 2025 to 2026, but it's the extension of the current tax brackets. So this is a snapshot of where they fall right now. If nothing was done this summer in the law sunset, these were going to increase by probably 3 to 4 percentage points across the board. So by having this get extended and made permanent, that is a positive for people. So again, we know that this will change over time. And I think that's where we kind of look at tax planning again. We want to take the long term into account. I think this one is an interesting slide when you kind of think through tax legislation historically. You can kind of see where we're at today. So the red line is the maximum individual income tax rate. The bottom one is the maximum capital gains rate. And so again, those would both apply for the people that we're working with, and specifically for practice owners. If you sell your business, you could be subject to the capital gains rate. Everyone is subject to the income taxes rate, but these will fluctuate over time. We are still in a relatively low historical tax rate environment. So again, we kind of think through where things are going, and I would say that we don't forecast what we think is going to happen in politics. We know there's going to be changes. We don't know how they're going to change, but we can kind of look at history and see a little bit of where we're at and where we're going and kind of adjust according to some of those items. And then on the estate planning side, again, we've had some various webinars that really kind of dive deep into this. So we won't go specific into a lot of these areas, but the big things when we kind of think about, again, what's the most important piece, generally the top thing is protecting your family and beneficiaries. The next kind of important thing that we hear from people is, how do you want to transfer assets? Again, maybe it is your practice, maybe it's retirement assets, maybe it's a combination of everything, but how do you want to transfer those assets to who? Again, we see commonly in business, including in medical practices, you may have somebody in your family in the business with you, whether that's a spouse or a child or a relative. Is there going to be some considerations there? Maybe you have family members that are not involved in the practice, but you want to make sure that you provide some charitable intentions for them as well. I think the biggest thing with the estate planning side of it is being proactive in adjusting this. I think when we talk about estate planning, we try to make it a little bit less of this big, kind of outstanding thing. We try to say, think in more like 3 to 5 year increments. If something unfortunately happened today, how would you want your estate to look? Because with a lot of the estate planning that we're helping clients with, they can make adjustments if life changes. If all of a sudden, again, you fast forward 10, 15 years, maybe now you have grandchildren in the mix as well, and you want to help them with college or things like that. We can help solve for that as we fast forward throughout time. The big thing is we want to kind of look at a snapshot today and say, if something happened today or the next 3 or 5 years, what's the most important piece to me? The other thing that happened this summer with the One Big Beautiful Bill Act is that the estate tax exemption did get extended and made permanent as well. We always caveat and say made permanent in the sense that it's permanent now, but again, future legislation could change that. So as of right now, it's $15 million per person. So for a married filing joint couple, it's 30 million that you can pass on with no estate taxes. But again, there's still some considerations that should be had, especially if you are upwards or approaching those estate values, ways that you can isolate some growth outside of your taxable estate or making gifts again today. And here there's really, again, not always a right or wrong answer, but I do say, again, when we think about estate planning, we kind of start from the foundation and work our way up. So we do think everyone should have a will, revocable trust, maybe part of that, it may be a testamentary trust, but then the powers of attorney, both of the medical and financial decisions, and then kind of, again, who you want to have these roles. Same thing I just referenced, but I think there we think in 5 or 3 to 5 year increments, because again, life will change and this may change as well. Again, kind of some of the basic estate planning goals that people have. You are allowed to give up to 19,000 per year per person, or 38,000 if you're married, to anyone, and not have any tax implications of that in terms of the actual gift itself. So again, there's not always a right or wrong answer. We work with people that want to leave more at the end. Some people want to give earlier and see the benefits of it. But again, this is kind of more of a personal situation that everyone thinks through this a little bit differently. And then I'll kind of go through the next ones here a little bit quicker, but through the intermediate to advanced and some of the charitable things, again, this is kind of where we want to take a big step back and look at what people have in place and see, again, what's important to them. Is there any additional benefits to doing some of these other items? With the extension of the current estate tax laws, there's maybe less of a rush to get some of this in place. It was going to sunset at the end of this year, but now that's got extended. So there's less of a rush. But again, I think a lot of it's still important to think through and kind of work through with your advisor team. This is, again, why we talk about estate planning and we look at the exemptions. It really wasn't that long ago. If you look back 20 years ago, that the estate exemption was not that high, and it brought a lot more people into the mix. we kind of look back now the last 7 or 8 years, it did get increased pretty dramatically. This is a huge benefit for practice owners, business owners, doctors, anyone that kind of gets above some of those lower tiers that it once was. But this is also something that we want to continue to monitor because, again, even though they extended and made this permanent, there is still the potential that a future administration could come in and change this. And so, again, I think being prepared ahead of time helps prevent, sometimes the negative consequences of not having a plan in place. All right, we are going to take a quick pause. So if you would like to receive CPE credits, there's going to be a question that we will pop up here. So take a quick minute break here to make sure that everyone has a chance to look through this, and then we'll restart here in a minute. Perfect. So we'll pick back up with the risk management piece of this. I know Lauren mentioned this a little bit earlier, but we kind of think through the 5 Ds, the death, disability, disagreement, divorce, and distress. And I know we talked about this also, but a big component of the business value is the transferability. So again, a lot of this is making sure that you have documents in place and pre-planned for to help ensure that, again, someone else can come over and take on the responsibilities that the practice owner was doing, the primary, again, physicians were doing. So I think that's always something that we think through. When we think through part of this, like with the sole owner example, there's twofold here. Again, will my family be okay? And then what happens to the business? And I think something that we think through, a lot of times people are insured for the death of the 5 Ds scenario, but maybe under planned for on the disability side. Again, we do see, sometimes, and we hate when this happens. Let's say that somebody was in a car accident and they were disabled and they couldn't work. It may not be just their family that's relying on them. It may be some of their other business employees and associates. And that's something that, again, we would hope that people have a plan in place ahead of time to make sure that, again, the business can go on. Maybe some of these, and we'll talk a little bit more in depth, but maybe something is in place that you can bring on another physician and have the insurance of there to help pay for their ability to work for the business and keep things going while that person that was in an accident or had an event can't work for that time being. The other one is a buy-sell agreement here too. So thinking through what some of the triggering events would be in that situation. So again, if someone's disabled and they won't ever be able to return to work, is there a way that you can still sell the business and have things keep going? The purchase price is a big one here too. Potentially the payment terms, and this can come down to the tax impact as well. Whether it's a lump sum, maybe the business needs to transition over multiple years, just from a cash flow perspective. These are all things that, again, should be solved for, should have a plan for ahead of time. And again, we hope this never happens, but unfortunately, we see in our world that there's more times that this happens than we would like. But the people that have a plan in place are the ones that can transition here a little bit more smoothly. Thinking about the business as well. So again, I think one of the common things that we see when clients come in is they maybe plan for life insurance on the personal side so we can take care of their family, but maybe potentially not on the business side. So what would the business proceeds be used for? Again, potentially helping keep the business going, figuring out what's next for the business, but then also the structure of how the insurance is set up for the business here too. And this is where everyone's situation is unique. The sole owner has a vastly different insurance need versus a partnership where there could be 2, 3, 4, 5 or more doctors working for a practice, if one person is out with a disability, the other ones may be able to continue on a little bit more seamlessly than if it was a sole practice kind of situation. So again, knowing your situation is helpful. But then also again, here legislation will change periodically. So recently there was a case called the Connolly case where life insurance was included in the value of the business. Well, then that ended up causing an estate tax problem for the family, and that can obviously be a detriment to what the goals were with the insurance in the first place. So some of us are just reviewing things periodically. It may not necessarily be something you have to review every time you get together as an organization and meet, but probably at least once every few years, review the documents you have in place, the buy-sell agreements, the insurance and how it's structured, and make sure that there hasn't been any, vast changes that really need to be accounted for here. The other side of the business life insurance side, be a key person. So again, let's say that you have one or two key employees that drive a lot of revenue for the business that aren't owners or aren't partners. Does there need to be some protection on that situation if there was, again, potentially gap in coverage for clients coming in and things like that. So something to consider and evaluate. This here too is probably very situation by situation based, that there's not really a blanket answer for here's what works for everybody. That's going to be very unique to each situation. Again, similar to the life insurance for the business, disability insurance for the business is one here that unfortunately we see more often that we would ever like. But if someone can't return to work, is there the ability for that person to buy out or to be bought out by the other key execs or key owners of the business? But then again, same thing on the key person coverage here too. If one or more of the key doctors isn't able to practice, does that slow down the amount of clients that you can see? Does that impact other things with the business as well? And you kind of see that with the business overhead expense coverage also. So if you have any questions or are curious on how this works, certainly reach out. Again, we always say that we want a lot of this coverage to help kind of think more from a continuity perspective. There are some tax benefits to the premiums that you're paying on insurance. So something that's worth considering. But again, it's still something that's probably more case by case.
And I will just say, while we're on this slide as well, Tom, we unfortunately have seen this play out a lot in the last 2 to 3 years, where solo practitioner situation becomes incapacitated, still alive, but unable to come to work. And so that really caused a business disruption. There's no production coming in. The employees are still showing up to work. They still have to pay, the overhead. And then they're working to get temporary coverage and contractor providers to come in to maintain the operation, but it just causes kind of a fire drill when this type of stuff happens. And then of course, there's that gap period while the people still going to the practice or trying to figure things out to figure out how to keep the lights on, so to speak. But having something like this is often not necessarily thought of, but probably the most necessary when there's a situation like that comes up.
Yeah, and again, I think every situation is unique, and you see that, and that's where some of the planning ahead of time can really help prevent some of those, again, catastrophic situations. Thinking through kind of some of the other D issues when you think of the 5 Ds, divorce, unfortunately, there's not really any sort of insurance policy that you can have in this situation, but there are documents and agreements that you can have in place to help keep the business going and being operational. We kind of tell this to people too, if you have a partnership or multiple owners, a lot of times they don't anticipate ever being a co-owner with somebody's ex-spouse. So having some of these documents in place can help make sure that the business is going and everyone that's still an owner is kind of rowing the boat in the same direction and working towards the same goals. So again, some of those prenuptial agreements can help with that side of it. The buy-sell agreements can have some of those consent clauses in there as well that a spouse agrees ahead of time before there is, kind of these fallouts, that they agree to sell at specific terms. And we'll kind of get to this on the next slide here too, but setting a fair price in these situations is something that's beneficial. The distress side of it too. So again, unfortunately, we live now in a time that sometimes these, uncharacteristic things happen, where, again, we're talking about professional liability, obviously with medical practices, this is one that we would never want to see this happen. But if there was a lawsuit against your organization, you want to make sure that you have some of these insurance policies in place to help keep things going. Business interruption, cyber insurance. So we are seeing more and more hacks out there. A lot of this stuff that, again, you have a lot of very critical data on your systems. So having some of these other coverages are, again, just helpful to have in place. And then disagreement, we kind of talked through on one of the very first pieces that, over 50% of transitions aren't necessarily exactly what people planned ahead of time. I think most people go into business expecting that the transition planning will be seamless and there's not going to be any issues. But again, things change, directions change, goals change. I think having some of these documented ahead of time when everyone is in agreement, you can kind of just put some guardrails around if something does change and all of a sudden, maybe you're not in alignment. If you ultimately can't come down to some sort of agreement, you can always go back to the documents you have in place and reference those and say, look, this is what we both agreed to is fair. How can we make this, again, most fair for everyone involved at that time?
So I'm going to talk a little bit more about the buy-sell agreement Tom mentioned earlier, especially this is applicable when there's a practice with multiple physicians and it's not a sole owner situation, but really thinking through, is there a buy-sell? And a lot of times we call it a buy-sell agreement. This could be incorporated into a stock restriction agreement or a shareholder agreement, on operating agreement. There's many different types of actual legal documents that you may have for the practice or for the business that this provision would be incorporated in. So it doesn't necessarily have to be called a buy-sell agreement per se. We've seen it in a variety of those different documents. But it's essentially a legally binding agreement that outlines how ownership can be transferred and then how that is going to be calculated and how that valuation formula will work. And I will say a lot of times groups don't even know, especially when we get engaged to talk through this process with people, they either don't even know if this exists. So I would encourage you to dust off your documents and see, do we have a buy-sell agreement in any of our documents? What is outlined and does this still make sense? Too often these documents were created 15, 20 years ago, and in a multi-owner, multi-provider practice, oftentimes a lot of things have changed since these documents were originally put together. So I would encourage you to review them and make sure it still makes sense. Maybe they were put together when it was two people, family owned, two physicians that were family 20 years ago, and now there's 4 owners and nobody's family. Does that still make sense? So just explaining some of the scenarios we've seen recently to make sure is the document that is in place makes sense? Does it need to be updated? Or and if there's no document in place, we do encourage you to get something in writing. It's really important to have. And everybody agrees until they don't, right? So it's important to have it in writing before you actually have to perform a buyout or a calculation, because it takes the question and the validity of the numbers. It's all written ahead of time. A big area we see is if there's an entity that owns real estate that's separate from the operating PC, how's that going to be evaluated? Are you going to require a third-party appraisal, or are you just gonna use whatever the property tax assessed value is? There's a lot that needs to be agreed upon, because those could be 2 completely different values. Well, of course, when the time comes, the existing partners are going to want to have the lower value, the exiting partner is going to want to have the higher value. So come up with the methodology ahead of time, have everybody agree, have it in writing to avoid really uncomfortable conversations down the line. Additional reasons to have this in place is it just outlines the triggering events that would spur the need to draw on these provisions in an agreement. And then, of course, it just creates that stability that there's a predetermined method and there is succession planning in place. This offers financial stability and overall, what I would call just culture stability. I think we see a lot of times when there's questions on this or unknowns, then it creates a rift within the culture of a multiple provider group. If there's, some people might be upset that they're unsure, or they think they're gonna have this big buyout when maybe they don't. And I think having it in writing, knowing the numbers and values ahead of time is extremely beneficial for a variety of reasons.
And I think one additional thing on that is, again, your goals as a business may change over time as well. Back to kind of the comment that Lauren made with it may be 15 years old. The estate tax laws were significantly different 15 years ago. You may have been intentionally trying to keep the value low to transfer it to the next generation without an estate tax problem. Now that's not there. Maybe you did bring in additional owners that are not family members, and maybe you need to now get the valuation based off of a different metric entirely. So those are things that, again, we would just say it makes sense to review and potentially update, but review at the least just to make sure that it still fits with what, again, kind of the intentions were from the starting point. So when we now think about kind of the next phase here, it's kind of going more specific back to the personal side, thinking of retirement savings. And again, we call this the buckets, some of the buckets of like what people may want to start to build. I would say in a perfect world, someone would have an even amount in each of these three buckets, because then they can really control a lot of their flexibility throughout retirement. The Roth bucket. So when we think about Roth and how that works, you are not getting a deduction today because you expect to be in a higher bracket later. So again, this is something that you probably see works a lot more when you're early in your career, younger, in a lower tax bracket versus being kind of in your peak earning years. But there's also considerations that maybe you're always going to be in a high tax bracket. You want to diversify your balance sheet. So there's some things to think about on that side. Pre-tax, I would say, is what we see most commonly, especially in the medical field. A lot of times the doctors come out of medical school being a very high income earning person. So all of a sudden they should try to save on taxes immediately. And that can be beneficial. But if they are always going to be a high bracket, or potentially even in a higher bracket later on, being going back to the situation where if they own their practice and let's say they have income coming in throughout retirement from the buildings or the real estate or even from the practice itself, they may always be in a high bracket. They may be in a higher bracket later on than they are now, and they have multiple income sources. So this is something that, again, we think is worth considering probably on a year-to-year basis of which of these buckets makes sense to do when you're kind of saving for retirement. But the last one, the taxable bucket, think of this as like a brokerage account. It can be an individual joint or trust account. Here, your dollars are going in on a after-tax basis, but then any growth is going to be taxed at capital gains rates, and dividends and interest can be taxable as they're received. So again, this bucket gives you flexibility. With the Roth and pre-tax, there's generally IRS stipulations on what age you have to be to pull these funds. The taxable bucket doesn't have that. So again, this is where you can start to build flexibility for some of your goals. And this is where everyone has different goals in that sense. If you plan to retire early, that taxable bucket can be very important. If your goal is to have a vacation home in retirement, again, you want to have some of these buckets that you can pull from and not potentially have your entire balance sheet tied up in pre-tax assets that then you're trying to figure out how to access these funds in the most tax efficient way. And that kind of brings us to some of the advanced strategies, especially for physicians. So again, we'll go through this on the next slide, but a cash balance plan, a lot of these considerations up here may be for somebody that is already maxing out their 401k. They're already maxing out some of the other kind of easier buckets like your health savings account, the backdoor Roth IRA. The cash balance plan is going to be, again, very specific to a practice itself. And it's worth going through some of the census information to figure out if you qualify, if it makes sense to do. They can be expensive, but it can also allow the people inside the practice to really ramp up savings and save on taxes when they are in those peak earning years. So we'll kind of go through that. Another consideration is that mega backdoor Roth, and it can be inside of your 401k or 403b. This could potentially even be like a solo 401k or 403b. So some considerations there. If you already are maxing out your employee amount, you can put in potentially up to the IRS limit and then do that on a conversion basis. So if you think that you are kind of in the camp that this works for, we're happy to elaborate a little bit further, but we want to at least people to know that that's out there. And then this was another one of the changes with the recent tax legislation. And again, another reason why we recommend monitoring this on a go-forward basis. The Secure Act 2.0 changed some of the catch-up provisions. So for anyone now it's age 60 to 63, you get a little bit extra catch up. Instead of being able to contribute the 7,500 catch up, you can now do 11,250, and that will have some inflationary bumps as well, like some of the other catch up provisions. The other big thing, and this is starting next year, is anyone that's considered a high income earner. So again, this could even be somebody that's in their practice that's not a doctor, but is still in that highly compensated bracket. Their catch up contributions do have to go into the Roth bucket. So again, just making sure that everything is compliant on that side, planning for it, I'd say on a personal side from the tax side of it, but just something to consider. And then I think one of the last things that I've seen specifically that's unique to physicians is kind of, again, the consolidation of accounts. We have seen where, again, somebody maybe worked somewhere for a residency, then they went somewhere else for a couple of years, and they may have worked for 4 or 5 different, hospitals, organizations before they ultimately land somewhere that they stay for a long period of time. Unless they are rolling those 401ks, they may have multiple accounts outstanding. I've seen people that have, again, 5 to 10 different accounts outstanding that they've lost track of just because there's so many places, and they thought they had them all rounded up, but there's still other ones out there. One new feature, again, part of Secure Act 2.0, that's nice. There is a retirement savings lost and found database. So again, I would recommend everyone just go through it. I've gone through it myself just to figure out how it works, but it's easy to do. You kind of see if there's anything outstanding, but just making sure that your dollars are working hard for you. Just one last note on that. I've even seen people where they thought, oh, I have, a few $1,000s in these old plans. Well, if they were invested aggressively when they were left there, they could be worth a material amount now. So something that's worth monitoring and just kind of checking to make sure there's nothing, outstanding that hasn't been accounted for.
I think one thing on that as well, you noted on the slide, your beneficiary cleanup. Again, unfortunately, I've seen too many times in the last 3 years where there's a situation where somebody did not update their beneficiaries, and somebody that they did not intend to be the beneficiary ends up getting the proceeds from a life insurance payout, or the proceeds from a buyout in an instance of a death or something like that. So it goes without saying as we're going through all this, but also make sure your beneficiaries are updated. I myself went through this exercise not too long ago. I thought I had updated my beneficiaries and I did not. So I still, like, when I first started my career here over 10 years ago, wasn't married, didn't have kids, I listed a beneficiary in my retirement account. That person was still listed. So I live and breathe this all day long, and I even forgot to clean up one of my beneficiaries. So sharing that, because it can really impact maybe an unintended outcome.
Yeah, and that's one that, again, you don't think about because as we're all going forward, it doesn't impact anything. It's always kind of in that time of, again, the worst case scenario that now someone's trying to figure out how to sort things out on that side also. Here is just a hypothetical example of a cash balance plan. So again, I think the takeaway that you can kind of see here is in that cash balance column, just how impactful this can be from a tax saving perspective. The tax savings here, I'll put a caveat, that's assuming the current top tax rate and then the Nebraska tax rate. So again, you can see that this can be a material impact. It may not make sense for every plan. There are companies that it won't work for. But if you're considering, should we or shouldn't we, it's at least worth reviewing and going through the process of seeing if it does work, because this could be a material savings for your organization. Thinking back to kind of that individual retirement and things that are important to think about, I think ultimately as we fast forward from that more working accumulation phase towards the retirement distribution phase, these are things that we think through with clients. The last thing that we would want to have happen is somebody's getting ready to retire. They're excited, they're happy, they're selling off in the sunset. They didn't check their investment portfolio, they're invested really aggressively. And then something like 2009 happens, and all of a sudden, half of their investments have been wiped away on paper because the market had a pullback and we're in a recessionary time period. So again, we think of this in the buckets. As you get closer to retirement, filling up buckets 1 and 2 here, or kind of that cash flow reserve bucket, is more important. We know we're going to see market volatility at some point in the future. We don't know when, but again, I think the big thing here is planning ahead and making sure that you have an appropriate allocation, given your goals and given your phase of life. This is one too that I think is much more unique to people specifically than just like a generic, oh, I'm X age, I'm a risky person or a conservative person, what should my allocation be? A lot of it's based off of, again, what you have going on. Back to the example of if you're going to have income coming in from the practice or consulting, that person, their situation is vastly different from somebody that sells everything, walks away, and they're planning to live just off of the kind of the principle from that sale altogether. So again, I think these are things that are unique to everyone's situation, but always worth considering and planning for ahead of time. And then the last slide that we have here when we think about investments and financial planning is the investments themselves. And I think, again, I think in general, the financial industry does a bad job of prescribing before they diagnose. And we kind of use the analogy to bring it back into the medical world. If somebody walked through your doors for an appointment and all you did was do height and weights and said, oh, you're good to go, there's a lot of things that was probably missed. Again, you may want to do some blood work or take blood pressure or do some of the other exams that are required to really understand what's going on. I think it's the same thing in our world on the financial planning side. And I kind of talk about that a little bit. Everyone's situation is unique. Your goals are going to be unique. Some people want to leave a legacy for kids and grandkids. Some people want to leave a legacy for charitable or philanthropic items. So again, I think these are all intended to show that all these different spokes on this wheel should impact the investment allocation. And again, I think that sometimes the financial industry does a bad job of prescribing before they actually understand what someone's goals or situation is itself. So I think when we kind of take a step back and look at the takeaways here from this, I would say again, the first one here is just evaluate everyone's situation and in what state that they're in. Again, Lauren kind of mentioned this, but we don't think it's the greatest idea to plan 30 days out from that transition. We think that you should plan a few years. I will say 30 days is better than no time at all. So the biggest thing is start today and kind of again think about what the goals are going forward. The next one would be again, make sure that you develop a succession plan and that I would say even that they know or at a certain point you bring that person in so that they know. So again, I think sometimes you can see that can help just make things more seamless if everyone's on agreement. We have seen before where again it could be parents that had these goals or intentions and they thought that their kids wanted to take over the business or the practice, but that maybe wasn't the kids' goals. So again, sometimes I think making sure that everyone's on the same page is helpful. Reviewing any documentation. So again, talked about buy-sell agreements. Anything that's outdated definitely is worth reviewing, but then making sure that everything is still, again, up to best practice. I would even say, we meet with estate attorneys with clients frequently. And even on that, those are worth brushing off every 5 years or so, just because the world has changed. If you think about, again, 10 years ago, if you haven't updated your estate plan in 10 years, you probably didn't have all the same online accounts, all the same passwords. Before we would always just say, hey, if mom and dad passed away, bring in all paperwork that gets mailed to them. Things might be electronic now. So you may need access to emails, you need access to some of their different financial accounts online to make sure that everything is again in place. So some of these estate documents need to make sure they reflect that. Otherwise, it can just be more cumbersome to get that information and have that able to pass on. And then the last one on here is actually create an action plan. So again, once you have these goals and you kind of have figured out, where you stand, just have those regular check-ins. I kind of use the kind of back to the medical analogy. Your best clients are probably the ones that come in for regular checkups, not the ones you see once every 10 years. When they're coming in once every 10 years, they probably had some dramatic changes from the last time. Same thing with your financial plan. The more regular that you have these tune-ups and checkups, the more it can prevent kind of that big catastrophic event from happening.
Yeah, I mean, you hit the nail on the head with all this. I would just kind of close with saying effective retirement planning is crucial for maintaining the stability and the quality of keeping medical practices independent and then also the financial stability of the physician that's retiring. So we'll stay on for any questions. We'll see if anybody has anything in the chat.
If not, we do appreciate you joining us in your time today.
So we had a question come in, just if we wanted to have a review of our succession plan and our currently Lutz clients, who would we speak to begin the process? You can certainly reach out to either Tom or myself and we can put you in contact with the right team.
Otherwise, yeah, if you have someone that you meet with, once a year, twice a year, mention it to them that you want to review them, and they'll make sure that they get it set up that, again, the right people are in the room to have these conversations.